The Income Tax Act 2025. Today is day 33 and I am revising various sections from section 37 to section 39, section 42, 40, section 56, section 57, various sections, starting with section 37, which talks about the expenses which are allowed only on payment basis. Means these are those expenses which will be allowed as deduction only if we make the payment before the due date of filing or before or on the due date of filing of income tax return under section 263(1). Some of these are taxes, duties, cess, fees, and surcharge. We know that we cannot claim deduction for direct taxes, so this is talking about indirect taxes. We have to make the payment before the due date, up to the due date of return of income. So, and also a clarification here regarding fees is given in a case law, which says that in case of electricity fees, it is not included in this section, meaning that in case we claim deduction based on the accrual of electricity charges, we can claim such deduction. There is no condition of payment up to the date of return of income. It's like any other normal expense. Then we have employer's contribution to these funds, employee welfare funds, or any fund as per the law. After that, there is the bonus or commission to employees. It's important to note that this bonus or commission relates only to employees. If we give any commission to any agent or any other person, it is not included under this section. Then comes the encashment of leave, which means leave salary. We also This also has to be made on payment basis. And then there is interest on loan taken from scheduled bank, which includes cooperative bank, public financial institutions, SFC, SIIC, or NBFC. This is talking about the payment of interest to banks. We have to make sure that we make the payment before the due date of return of income. This was introduced because at the time of at the time of making of this provision, most of the banks were government banks, and government wanted to make sure to maintain liquidity. That's why they wanted to encourage people to make payment early or on time. Here are few examples about the and few cases about the interest to banks. First one deals with when will we be allowed the deduction in various cases. So let's say the due date of return for BBBPL is 31st of October 2027. The interest has accrued for the tax year 26-27, and he makes the payment on before the due date or on the due date of return of income, which is in these three cases. So in these three cases, he will be allowed deduction in tax year 26-27 only. But in case he makes the payment in the next tax year, which is in this example of 15 December 2027, which is after the date of return of income, then he'll be allowed deduction in the next tax year. And if he makes the payment in the next tax year, which means April, crossing April 2028, this falls under the tax year of 28-29, then he'll be allowed deduction in tax year 28-29. There is a basic concept here which deals with, which says that when we have an expense which is accrued in a particular tax year, then the payment for such expense has to be made up to the due date of return of income of that tax year. But if it's not made in that within that due date, then the expense is allowed in the tax year in which the payment is made. Then there are few scenarios of the same example. This says that if we do not make the payment of interest and instead convert it into loan, what happens in that case is it is not treated as actual payment, and therefore there is no deduction allowed to the SSA. And then we have, if this loan, if the bank converts the payment of interest in EMI form, which means like in our example we have 5 lakh rupees of interest payment, but the SSC is not able to make it, so the bank turns it into an EMI of 1 lakh rupees each in each year. So it will be allowed as and when the payment is made, like in on 15 December 2026 we made the payment of 1 lakh, it's allowed in 26-27, then 27-28, and accordingly. Then in case of interest payment, In case we decide to convert the interest payable into bonds or debentures, it's again not treated as actual payment and no deduction is allowed. But when we'll redeem such debentures and make payment for them, then it can be treated as an expense. After that comes the case of equity shares. If we convert such interest into equity shares, then it is considered as actual payment. This was laid down in the case law of Frontier Infotech Limited, Telangana High Court. Then we have last two cases which deal with the payment to Indian Railways for use of railway asset and the case of MSMEs. So in case of MSMEs, this provision deals with the micro and small enterprises. This does not deal with medium enterprises. Micro enterprises are those which have the investment in plant and machinery of up to 2.5 crores and a turnover of 10 crores. Similarly, small enterprises are those having investment in plant and machinery up to 25 crore and a turnover of 100 crore, up to 100 crore. So in case we receive any goods or services from micro or small enterprises, when do we have to make the payment? So this provision is a little bit different from the other items in the list, which says that we have to make the payment before the due date of return. In this case, the rules have been set out in the MSME Act under section 15 of the MSME Act, which says that in case we have a written agreement regarding the days within which we have to make the payment, then in that case we'll follow that only. But the number of days cannot exceed 45 days, so we have to make a payment at maximum of 45 days, within 45 days. And in case there is no agreement regarding the payment period, then we'll have to make the payment within 15 days. There is an interesting case about this, like in this example, where we have purchased goods on 2nd of March and we have no agreement regarding the term of payment. So the term of payment should logically end on 17th March, but we made the payment on 30th of March. In this case, we will be allowed deduction in the same tax year because we still made the payment we accrued and made the payment of the liability in the same tax year, within the same tax year. But if it was after the completion of the tax year, like in this example here it is 6 April 2026, then it will be allowed in the next tax year. Further, there is a note which says that this section 37G regarding MSME is applicable only when the goods or services are purchased from manufacturers and service providers. This is not applicable in case of a trader MSME. The next section is section 38, which is deemed PGBP. The first part of this section is section 38, subsection 1 and clause A. This deals with the cases where an SSC has claimed deduction of any expenditure of any loss or any trading liability in the past. But now what happens? Now he gets a refund of such liability or such expenditure, or his liability or expenditure ceases to exist, means cessation of any trading liability. Then in such cases where he had earlier claimed deduction but now he receives the amount back or he does not have to make the payment of it, in such cases such amount of deduction claimed will be added to his income under the head PGBP. A few examples are here, like a person has claimed deduction for GST paid, but then he receives a refund of such GST. Such refund amount will be included in his PGBP income. And also, if he has some electricity charges, he had claimed the deduction on accrual basis on such electricity charges, but now the government waived off electricity charges on people, so he does not have to make the payment of it anymore. So this amount will also be included in the PGBP income of the SSC. Another example is here, where Mr. BB has purchased goods worth 5 lakh rupees in tax year 24-25. He has showed it as an expenditure in his books of accounts and claimed deduction accordingly. But then in tax year 26-27, the supplier dies and he does not need to make the payment of such amount, so he will write off such creditor from his books of accounts, and therefore this will again become taxable under the head PGBP for Mr. BB. Another example is another cases of time barred. When assuming Mr. BB made a purchase of 5 lakh rupees in tax year 24-25, but in tax year 27-28 it became time barred and he did not make the payment of the same. So legally he is no longer required to make the payment of such amount. So should we include it under PGBP? The answer is no, because just because it has become time barred, it does not mean that we will not make the payment of the same. It's up to us whether we want to make the payment. We can make the payment even after 4 years. We can carry the liability in our books for however long we want. So it's up to us, therefore it will not be added in the PGBP income. However, if we decide to write it off in our books of accounts because we don't want to make the payment, in that case, after writing off it in our books of accounts, this will form part of our income under the head PGBP. Another case is of loan. When we have received any loan from bank, whether it will be and that loan is written off by the bank, then whether it will be included in the PGBP income or not, it depends on what kind of loan it was. If it was a loan other than working capital loan, then it will not form part of the income. But if it was a working capital loan, then the principal amount will form part of the income under the head PGBP. However, any interest amount outstanding will not form part of the PGBP income, because section 37 comes into play here. Because in section 37 it said that we had to make the payment of interest with before the due date of return of income. So in this case, if our interest payment is outstanding, we should we would not have made the payment of such interest amount, and therefore we would not have claimed any deduction on such amount, and thus there is no income to add back because we have not claimed any deduction in the first place. Then it talks about the cases of amalgamation, demerger, or succession. In case of amalgamation, if the entity has claimed deduction before amalgamation, the same will be included in the income of the amalgamated or demerged or successor entity in case of these three cases. And then there is a case of unilateral act. If the assessee has written off the liability without getting the consent of creditor, it is deemed to be the income. But it's not the same case in case of creditor. In case the creditor writes it off in his books of accounts, we don't get to add this in our income as long as we have it in our books of accounts. Then the last point is regarding the waiver of loan by government. So it is treated like subsidy under section 2 subsection 49 clause W, and it becomes taxable. Then comes section 38 subsection 1 clause C. This is the case of sale of scientific research asset. So there is an example of Cipla Limited. Let's assume they have a scientific research lab which has been closed down. So when this lab would have been set up and assets would have been purchased, they would have claimed deduction under section 45(1), which is 100% of the cost of the asset. But now when the lab is closed, what will they do with the assets? If they decide to use the assets in their business, then this asset will be added to the block of asset of the business at a cost of nil, because of section 39 subsection 4. It says in this particular case the cost of asset would be nil. And then if they decide to sell it after using it in their business, it will be treated normally as per section 74, which means it's treated it's added to the block of asset, then sale goes from the block of asset normally like any other asset. But if the if Cipla Limited decide not to use it in business and directly sell the assets off, then in that case the income from PGBP would be lower of these two. First one is selling price of the asset, and the second one is deduction claimed, which would be the cost of the asset because they have 100% deduction. Lower of these two amounts will be included as income under the head PGBP. Like in this example, the AC was cost of AC was 1,50,000, and after the closing down of the lab, it was sold for rupees 70,000. So lower of 70,000 and 150 is 70,000, and this 70,000 will be included as income from PGBP. We also have to make sure that we take into account capital gains in case the selling prices exceeds the cost of the asset. Like in this example, if the selling price is 1,70,000 rupees and the cost of asset is only 1 lakh 50,000 rupees. The income under that PGBP will be lower of the two, which is 1 lakh 50,000. But we'll also have capital gains, which will be the difference between the selling price and the cost of assets, which comes to 20,000 in this case. Then we also have a few sections, which first one regarding balancing charge, it was already done with power units in depreciation. Recovery of bad debts already done. This is not being done right now. And then there are common notes regarding this section 38 as a whole. It says when the business is no longer in existence, then any brought forward loss other than speculation loss can be set off against deemed income under section 38(1) A, C, D, and E. So in case of section 38, except for this balancing charge case, in this case if we have a brought forward loss and the business is no longer in existence, and then we have some deemed income under this section, we can claim we can claim deduction of that brought forward loss against that deemed income. Means we can set it off against the deemed income. Other point is deemed income under section 31 B, C, D, and E shall apply to the original SSE. It was like in the case of partnership, we saw bad debts recovered. We saw that in case there is a bad debt deduction claim by a partnership, and then the partnership is no longer in existence, then the partner is able to recover such bad debt. It's not an income for him. This is talking about those cases only, 31B, C, D, and E. It does not deal with section 38 1 subclause A, because we have the case of amalgamation demerger here, in which the new entity, which is amalgamated or demerged entity or successor entity, has to include it in his income under section PGBP. The next section is a small section, section 40, which says determination of cost of acquisition of stock in trade. It deals with the cases of amalgamation, gift, partition, will, or irrevocable trust, where a capital asset is transferred by a transferor and it becomes the stock in trade for the person receiving such assets. Then what will be the cost of asset for such person who has received this asset? So the cost of asset will be the cost of asset of the previous owner plus any cost of improvement incurred by him, or the incurred by transferee as well as the transferor, plus any expenses which have been incurred by the transferor. The next section is section 42, which deals with the asset acquired from any foreign currency. It says when we acquire an asset from a foreign country using a foreign loan or supplier's credit, then in that case any gain or loss on the difference in exchange rates at the time of actual payment will be adjusted in the block of assets. This is a case where we are purchasing a foreign asset from a foreign country, and then we are making payment not at the time of purchase but at a time in the future because of supplier's credit or any foreign currency loan. So because of the delay in the payment, there will be an exchange difference. It will either result in a gain or in any loss, and that gain or loss will be adjusted in the block of asset. Means if there is a gain, if there is a loss, it will be added to the cost of the asset. If there is a gain, it will be reduced from the cost of the asset. An example is this, where AK Limited acquired a plant and machinery for $1 lakh from USA on supplier's credit on 16th of July, but he made the payment in the next year on 15th of Feb, $40,000, and then on 19th of October $60,000. And these are the exchange rates. So when he acquired it on 16th of July 2026, he will record the asset in his books of accounts at $1 lakh multiplied by the exchange rate on that date, which means $1 lakh multiplied by 80 gives 80 lakh rupees. But then he makes the payment in February, $40,000, and at that time the exchange rate is rupees 89 per dollar. So there is a loss of rupees 9 because of the delay in payment. This loss will be added to the cost of the asset. So 9 rupees multiplied by $40,000 will be added to the cost of the asset, which comes to 80,000 is added as the initial cost, and then the loss due to the foreign exchange rates 9 rupees multiplied by $40,000 is added as $3,60,000, which gives us $83,60,000, and then depreciation is calculated on this amount at 15% or whatever rate is depreciation rate. And then he makes the another payment. He makes the payment of next installment on 19th of October. At that date, the exchange rate has dropped and it is 76 per dollar. So he has a gain of 4 rupees compared to rupees 80. So this gain of 4 rupees will be multiplied by $60,000 and it will be reduced from the cost of the asset. So here we have, since it's in the next year, the payment is in the next year, so we will have firstly the opening balance, which is carried forward from the last year, brought forward from the last year, and then we will reduce the gain on difference in the foreign exchange, which is 4 rupees multiplied by $60,000 gives us 2,40,000 rupees. This will give us the WDV for calculation of depreciation, and then we will charge depreciation accordingly. And there are a few notes here. Rate of foreign exchange will be determined by the central government, and in case it's an authorized dealer as per FEMA, then that rate will be considered. Next section is section 56, which deals with the interest income on NPA, which is bad and doubtful debts. So as I know that when a, when a deposit turns, I know that when a loan is given by a bank and it is classified as NPA because of non-payment of interest or principal amounts, then the interest income on such NPA asset is not accrued in the books of accounts for income recognition purposes. Same is the case in income tax, where the income will be chargeable to tax in the tax year in which the amount is either credited by the SEC to its P&L or actually received by the SEC, whichever is earlier. Means when the bank recognizes such income in its profit and loss account, or when the bank actually receives the amount of interest, then only it will be charged in the as per the Income Tax Act. Then is the last section, section 56, section 57, which deals with the income from construction contract or service contract. In case of construction contract, when will we recognize the income as per the Income Tax Act? It is same as in DS, where we recognize income only on the completion of the work. The amount of work we complete, we recognize that portion of the revenue as income. It is called percentage of completion method. Like for example, we have a contract for 10 lakh rupees. We have completed 50% of our work, so we will recognize 5 lakh rupees as our income in that tax year. After that, there is a contract for providing services. In case we are providing some service, there can be three different cases. In case the duration of contract is up to 90 days, which means we have a fixed duration of the contract and it is not more than 90 days. For example, a teacher launches a fast track batch and offers to complete the whole CA course in 60 days. Then in such cases, income will be recognized on the day the contract is fulfilled. Means when he will complete the whole course, like for example the course is completed on 5th of July 2026, then such income will be recorded on whole of the income will be recorded on 5th of July 2026. This is called project completion method. That means when the project is completed, income is recognized on that date of completion. After that, there is a contract which involves indeterminate amount of acts. An example is internal audit. We may have to increase the amount of procedures or decrease according to the situation. We don't know how much time we will take and how much activities we will need to perform. So in that case, we follow the straight line method. Let's say we will provide a service for 5 months and will receive 5 lakh rupees for the service. We'll distribute it over 5 months, like 1 lakh per month each, and then we'll see which month falls in which tax year and accordingly tax it. And there's the third case, which means in case it does not fall under these two cases, in all other cases we'll follow the percentage of completion method only. That is all.